64. That's the number nobody on Wall Street wants you to focus on. It's where the S&P 500 closed at the start of 2026, an all-time high. The Dow above 43,000, the Nasdaq north of 17,000, every major index sitting at record levels. On paper, it looks like prosperity. In reality, it's something far more dangerous. Right now, trillions of dollars in retirement accounts, pensions, college funds, and lifetime savings are parked at the very top of the market, and Wall Street keeps repeating the same comforting mantra: everything is fine. Buy the dip. Stocks only go up. The Fed has your back. But markets don't collapse when everyone is afraid. They collapse when everyone feels safe. Behind closed doors, the behavior is completely different. Hedge funds aren't buying the dream, they're buying protection. Insider selling is surging at the fastest pace in years. The so-called smart money is quietly reducing risk, while the public is being encouraged to do the opposite. That's not confidence. That's distribution. Here's the uncomfortable truth most investors never hear. Major crashes don't announce themselves with panic. They begin with optimism, with headlines celebrating new highs, with analysts explaining why this time is different, with retail investors convinced that any pullback is just another buying opportunity. That's exactly where we are now. And no, this isn't the start of a new bull market. It's the final phase of an old one, a phase defined by extreme concentration, record leverage, and blind faith in a handful of stocks to carry the entire system. When markets reach this point, history shows only one outcome, and it's never gentle. What comes next won't feel like a sudden collapse at first. It will feel confusing, choppy, manageable, until suddenly it isn't. In this series, I'm going to walk you through the exact pattern that has preceded every major market crash for more than a century and show you why, in 2026, that pattern is already playing out in real time. The question isn't if the market breaks. It's whether you recognize the warning signs before everyone else does. Type 1 to continue to Chapter 2. Type 2 to stop here. And if this perspective helps you see the market more clearly, subscribe to the channel and comment 1 below so I know to go deeper. Every major market collapse begins the same way, with reassurance. Analysts smile on television, headlines celebrate resilience. Pullbacks are framed as healthy. The language is calm because calm keeps money in the system. And in early 2026, the dominant message is simple: nothing is wrong. But history shows something uncomfortable. When risk is truly low, markets don't need reassurance. They move quietly. Volatility stays muted. People aren't talking about stocks at dinner tables. Right now, it's the opposite. Participation is extreme. Confidence is universal. And that combination has never ended well. The S&P 500 today is not a broad, healthy market. It is a narrow structure propped up by a few enormous pillars. 7 stocks. Apple, Microsoft, Nvidia, Google, Amazon, Meta, and Tesla now account for roughly 30% of the entire index. Let that sink in. Nearly 1/3 of the market depends on the performance of just 7 names. This level of concentration is not normal. It's not sustainable. And it creates the illusion of strength while hiding widespread weakness underneath. Hundreds of stocks are already in quiet declines. Many peaked months or years ago, but because the largest names keep rising, the index masks the damage. This is why so many investors feel confused. Their portfolios aren't performing like the headlines suggest, yet they're told to stay invested, to ignore the noise, to trust the system. What they're not told is that professional money sees something very different. When markets are healthy, leadership rotates, risk spreads out. When markets are fragile, leadership narrows, capital crowds into what feels safest right before it isn't. That's exactly what's happening now. The same trades are crowded, the same assumptions are shared. Everyone believes there will always be a buyer. But markets don't fail because prices are high. They fail because positioning is one-sided. When everyone is on the same side of the boat, it only takes a small shift to tip everything over. And the warning signs aren't subtle anymore. They're just being ignored. After 50 years of studying markets, one truth stands above all others. Prices change, technology evolves, but human behavior never does. That's why every major market collapse in history follows the same structural pattern. Not sometimes. Every time. There are 4 stages. Miss them, and the crash feels sudden. Recognize them, and nothing about it is surprising. Stage 1 is euphoria. This is where logic quietly leaves the room. Prices disconnect from fundamentals. Valuations stretch beyond anything that can be justified by earnings or growth. But no one cares because price itself becomes the proof. Rising charts convince people they're right. Wealth feels permanent. Risk feels theoretical. Speculation replaces investment. Borrowing increases. Margin debt climbs because leverage works beautifully until it doesn't. Anyone questioning valuations is dismissed as outdated, pessimistic, or incapable of understanding the new era. Sound familiar? Stage 2 is where the real danger begins. The market keeps rising, but fewer stocks participate. Breadth deteriorates. Leadership narrows. Gains concentrate in a small group of names while the majority stall or decline. Insider selling increases. Volatility creeps higher. Smart money doesn't panic. It quietly prepares. This stage is deceptive because indexes still make new highs. To the casual observer, everything looks fine, but under the surface, the structure is weakening. It's like a building that looks solid from the street while the support beams rot inside. Stage 3 is the trigger. It's never the cause, just the spark. A rate change, an earnings miss, a geopolitical shock, a credit event. The specifics don't matter. What matters is that the marginal buyer disappears. Without new buyers, leverage collapses. Margin calls turn selling from a choice into an obligation. Forced liquidation feeds on itself. Liquidity vanishes exactly when it's needed most. Stage 4 is the crash. Not a single moment, but a process. Waves of selling, violent bounces, false hope, and eventually exhaustion after massive wealth destruction has already occurred. This pattern has never failed, and in 2026 we're no longer guessing where we are within it. To understand where we are now, you have to stop thinking in forecasts and start thinking in patterns. Markets don't crash because of bad news. They crash because the system becomes fragile. And fragility always reveals itself the same way long before prices collapse. Look at the past. In 1929, the public believed industrial progress had rewritten the rules of economics. In 2000, it was the internet. In 2008, it was financial engineering and housing. Each era had its own story, but the structure underneath was identical. Extreme optimism, excessive leverage, and total confidence that risks were contained. Today's story is artificial intelligence, passive investing, and central banks as permanent backstops. Different language, same psychology. In every historical case stage, two lasted longer than people expected. That's why so many investors get trapped. The market doesn't immediately punish excess, it rewards it just long enough to pull everyone in. New highs become proof that warnings were wrong. Skeptics capitulate. Caution feels expensive. But while prices drift higher, something critical happens beneath the surface. Liquidity becomes thin. Positioning becomes crowded. The market's ability to absorb shock quietly disappears. When that happens, stability becomes an illusion. This is the phase where professionals stop talking and start acting. Exposure is reduced. Protection is added. Risk is transferred from institutions to individuals who believe they're being long-term investors. No announcement is made, no alarm is sounded, because alarms reduce exit liquidity. What makes this cycle more dangerous than most is speed. Technology compresses time. Algorithms don't hesitate. Passive flows don't think. When selling begins, it doesn't ask questions, it executes. That's why modern crashes feel sudden, even though the conditions took years to build. Right now, the market is balanced on confidence alone. Not growth, not earnings, not fundamentals. Confidence. And confidence is the most unstable asset in finance. Once it cracks, it doesn't bend, it breaks. Many investors hear warnings like these and immediately dismiss them with a familiar comparison. We survived 2008. That assumption is comforting and dangerously misleading. Because the conditions in 2026 are not safer than 2008. They are more extreme. Start with valuations. In 2008, the market entered the crisis with elevated prices, but today's multiples are significantly higher. When assets are priced for perfection, even small disappointments create outsized damage. The higher the starting point, the deeper the fall required to restore balance. Now look at leverage. In 2008, margin debt was substantial. Today, it's historic. Borrowed money magnifies gains on the way up and forces liquidation on the way down. Leverage doesn't ask for patience. It demands action at the worst possible moment. Then there's concentration. In 2008, the index was diversified across sectors. Today, market performance is dominated by a handful of enormous companies. This creates a single point of failure. When leadership breaks, there's nothing underneath to catch the fall. Add passive investing to the mix. Trillions of dollars now move mechanically, not strategically. Index funds don't evaluate value. They buy because money flows in and sell because money flows out. When selling pressure hits, these vehicles accelerate declines instead of absorbing them. Finally, consider behavior. Retail participation has never been higher. Millions of investors with limited experience are one click away from panic. Social media amplifies fear faster than any financial channel ever could. In 2008, fear spread through headlines. In 2026, it spreads instantly through screens in people's hands. This is why the next downturn won't resemble the past in speed or intensity. The system is tighter, faster, and more fragile. And fragile systems don't correct gently. They fail suddenly. Crashes never start with certainty. They start with pressure. Pressure builds quietly and visibly until the system can no longer absorb it. By the time headlines catch up, the damage is already underway. That's where we are now. Multiple triggers are forming at the same time, and that's what makes this moment especially dangerous. Any single one could cause instability. Together, they create a chain reaction. First, the global liquidity shift. For years, easy money acted like oxygen for risk assets. That oxygen is being slowly withdrawn. Higher rates don't break markets overnight, but they change behavior. Borrowing becomes expensive. Refinancing dries up. Risk tolerance shrinks. Leverage that once felt manageable becomes suffocating. Second, forced positioning. When too much capital crowds into the same trades, flexibility disappears. Everyone owns the same stocks. Everyone believes in the same narratives. When prices begin to fall, there are no natural buyers, only sellers competing for the exit. Third, earnings reality. Markets can ignore fundamentals for a while, but not forever. When growth slows and margins compress, narratives lose power. Expectations reset violently. Stocks don't fall because earnings dip. They fall because the future suddenly looks smaller than what was priced in. Fourth, geopolitical instability. Markets hate uncertainty more than bad news. Conflict, trade disruption, and political risk introduce variables that models can't price. When uncertainty rises at market peaks, risk premiums expand fast and prices fall to compensate. None of these triggers need to explode all at once. They just need to remove confidence. Once confidence breaks, leverage unwinds, algorithms react, and selling becomes self-reinforcing. At that point, the market doesn't ask whether selling is rational. It only asks whether positions can survive. Most can't. The most misunderstood part of a market crash is the speed. People imagine panic as an emotional response. In reality, the most destructive phase has nothing to do with fear at all. It's mechanical. When markets are highly leveraged, selling doesn't begin because investors want to sell. It begins because they have to. This is where theory meets reality. As prices fall, leveraged positions break their limits. Margin calls arrive, not as suggestions, but as demands. Add capital immediately or positions will be liquidated. Many investors can't add capital, so assets are sold regardless of price. That forced selling pushes prices lower, which triggers more margin calls, which creates more forced selling. It's a feedback loop with no emotion involved, just math. At the same time, algorithms respond to volatility and momentum. They don't pause to evaluate long-term value. They accelerate what's already happening. Liquidity disappears because market makers step away when risk spikes. Bids thin out, prices gap down instead of moving smoothly. This is why stop-loss orders fail in crashes. They execute far below expected levels. The market doesn't fall in neat increments, it drops through air pockets. What makes this cycle especially brutal is concentration. When the same stocks dominate portfolios, selling becomes synchronized. Everyone exits the same doors at the same time. There's no diversification benefit when correlations go to 1. This is the moment when disbelief turns into shock. Accounts that looked healthy weeks earlier are suddenly down double digits. News anchors scramble for explanations. Analysts talk about overreactions, but the process is already in motion. By the time the public understands what's happening, the most violent phase is usually over. The damage, however, is permanent. And this is only the beginning of stage 4. One of the biggest mistakes investors make is assuming a crash is a single event, a bad week, a terrible headline, then recovery. That's not how major declines work. They unfold as a process designed to wear people down emotionally and financially. After the initial collapse, markets often bounce. These rebounds feel convincing. They restore hope. Commentators declare the worst is over. Bargain hunters rush in convinced they're buying the bottom, but these rallies are not signs of health. They're symptoms of instability. Each bounce is weaker than the last. Each decline goes further. Optimism slowly drains as portfolios fail to recover. What began as confidence turns into anxiety, then exhaustion. This is where most long-term damage is done. Investors hold through the first drop convinced it's temporary. They hold through the second believing recovery is imminent. Eventually they sell, not at the bottom, but close to it, because they can't take the stress anymore. Meanwhile, institutions operate differently. They wait, they conserve capital, they allow prices to fall until value reappears. Crashes don't destroy wealth equally, they transfer it from the impatient to the prepared. Historically, this phase lasts longer than expected. 12 to 18 months is common. Sometimes more. Recovery doesn't begin when prices are low. It begins when sellers are exhausted and risk is no longer fashionable. The irony is painful. The moment when investing feels safest near market peaks is the moment when risk is highest. And the moment when investing feels unbearable near market bottoms is when opportunity quietly returns. Most people never experience that opportunity because they no longer have capital or confidence left. This phase is not about predicting exact lows. It's about survival, preserving capital, avoiding irreversible mistakes. Because once this process starts, patience alone is not enough. Preparation is what matters. As markets approach their breaking point, a familiar set of arguments always appears. These arguments don't protect investors, they trap them, and they sound reasonable precisely because they appeal to comfort, not reality. The first lie is that central banks will step in and stop the damage. The idea of a permanent safety net is seductive, but history shows that policy actions lag, markets not lead them. Rate cuts don't prevent crashes. They usually respond to them, and even when intervention works, it works after enormous losses have already occurred. The second lie is that technology has changed the rules. Smarter systems, better data, faster execution. But none of that eliminates cycles. In fact, it amplifies them. Speed doesn't create stability, it creates fragility. When everyone reacts faster, mistakes compound faster too. The third lie is the most dangerous stocks always come back. This statement is technically true and practically useless. Markets recover, but investors have timelines. A 50% drawdown doesn't just reduce wealth, it reduces options. Time becomes the enemy. Retirement gets delayed. Risk tolerance collapses. Opportunity cost becomes permanent. Then there's the final lie: buy and hold works for everyone. It doesn't. It works for people with decades ahead of them and strong emotional discipline. It fails for those near major life transitions, retirement, education, funding, business, exits where large losses cannot be absorbed. Crashes don't just test portfolios, they test identity. People who believed they were long-term investors discover they were only comfortable during uptrends. When losses become real, principles disappear. Understanding this isn't pessimism, it's realism. The market doesn't care what you believe. It only cares about positioning, leverage, and psychology. And right now, psychology is dangerously misaligned with risk. That misalignment never resolves gently. When this cycle finally ends, the market will look nothing like it does today. Prices will be lower. Narratives will be broken. Confidence will be gone. And millions of investors will ask the same question they always ask after major crashes. How did this happen? The answer will be simple. The signals were visible, the pattern was familiar, but acting early felt unnecessary until it wasn't. Investors who survive don't try to predict the exact day of a crash. They manage exposure before fear forces their hand. When valuations are extreme and risk is mispriced, protecting capital matters more than chasing returns. Avoiding a large loss does more for long-term wealth than squeezing out the last bit of upside. And that means accepting trade-offs. Missing a final rally is uncomfortable, but losing half your portfolio is devastating. Cash isn't a mistake in late-cycle markets, it's optionality. It gives you the ability to act when others are trapped. Survivors also understand what not to own. crowded trades break the hardest. Assets everyone believes are safe forever rarely are. Even great companies can become terrible investments when bought at euphoric prices. Timing doesn't replace quality, but it defines outcomes. Crashes reset everything. They clear leverage, they punish overconfidence, and they reward patience, discipline, and preparation. The biggest fortunes after downturns are made by those who preserved capital while others were forced to sell. History doesn't predict the future. It warns those willing to listen. The sequence never changes. Euphoria, warning signs, triggers, collapse, recovery. Only the names and narratives do. We are not early in this cycle. We are late. And late cycle mistakes are the most expensive ones investors make. If this analysis helped you see risk more clearly, subscribe to the channel, share this with someone who needs it, and comment ready below.